Hey, it's Patti Scharf, CPA and co-founder of Catching Clouds, the leader in e-commerce accounting. And today we are going to cover part 3 of our Understanding Financial Statements. Now we are talking about statements of cash flow. So the statement of cash flows is the third financial statement that kind of ties everything together. If you are ever in a position where you see that you're making money on your profit and loss statement, but you don't have any cash in the bank and actually you're kind of negative, the statement of cash flows helps explain how that happened or why you're where you are. So there are two different methods. One is the indirect method and one is the direct method. Today we're going to talk about the direct method. This is the method that Xero uses. Most people don't actually prefer this method. They prefer the indirect method because the indirect method starts with your net income and takes you through the full reconciliation. This one is, as it implies, more direct. It takes a look and it says your operating activities provided this much of cash and your investing activities provided this much of cash and your financing activities provided this much, giving you this net amount of cash. And people don't really like that as much because it doesn't tie back to what's actually showing on your profit and loss statement. So you still have to provide another supplemental schedule to kind of reconcile that out. So they'd rather do it in one step, which is done on the indirect method, as opposed to using this one. But with all that said, here is the direct method. The first section is operating activities. Operating activities is going to show you where all of your cash came from in your normal course of business. So you're selling products. When you receive money from your customers, that increases your cash. As you pay your suppliers, that decreases your cash. As you pay bills, that decreases your cash. So that's what's going on in the operating activities. When you have identified all of those transactions, you'll get a net cash flows from operating activities. Then you move on to investing activities. Investing activities are things like buying property or equipment for use in your business. You're investing in your business, but it's not really the normal operations of business. It's not the normal selling of goods and that sort of thing. It's you buy a piece of equipment and your cash flow goes down because of it. Or you sell some equipment and your cash flow goes up. So that's what that is, net cash flows from investing activities. The last piece is financing activities. This is literally financing. So if you take out a loan, that's going to increase your cash, but it's not part of your operations. It's increasing cash because you got financing. Or if you're paying down a debt, you're paying your loan down, it's going to reduce your cash flow. So at the end of the day, you look at all 3 of those sections and come up with your net cash flows. Then you take a look at how much cash you had at the beginning of the period and how much cash you had at the end, and those 2 numbers should match. So in this case, there was a net cash outflow of $20,000, and we proved that by looking at the bank account balances during those 2 periods of time. And that's the direct method for statement of cash flows. I hope you liked this video. If you did, please click the button and share it with your friends, comment. If you haven't already subscribed, please do, and we'll catch you next time. Thanks.